Hello and welcome to Options Playbook Radio. To Options Guide TV. Uh, my name is Brian Overby. I'm the author of the Options Playbook, and we got a long show today. We got a lot going on. We still have a potential government shutdown, which it doesn't seem like a lot of the pundits on the financial stations are really talking about. I'm a little bit more nervous than the VIX is, that's for sure. So I'm going to look at doing a long trade in the VIX today, but we do have to, look at our trade that we set up in Boeing. Boeing is looking fairly good at this point in time. Boeing has dropped off a little bit. We looked at a bearish put butterfly heading into their earnings report. And right now the stock Boeing is down. Let's run to the Tradier Pro platform. Boeing is down $2.50 on the day, and so far so good. As we head into that earnings report. So what do we do with it? We're right on. Here's the issue. Okay, so let me pull up the trade. We're going to buy. The structure is set up that we're using the January 30th expiration, 2 days away. We bought the 245 strike put. We bought this one. We sold two of the 240 strike puts, and then bought one of the 237. We did this for a total cost of $1. We're at 181 right now. And the market is just, I don't know, mixed, I guess. Other things that could lean into the weekend is just more news about the potential government shutdown. I don't know. Things are happening. Probabilities have gone down a little bit, but depending on the probability marketplace that you're looking at, if you're going to use the social networking platforms that bet on probability of events happening, they're talking about a 75 to 80% chance that there will be some type of government shutdown. Last time we saw the shutdown, the very first weekend or the first day or two, the markets did nothing. And it wasn't until we got into like day 15 or day 20 that people believed that this was real. So that's also something to keep in mind. Do we really think that if the government does get shut down, that it will be a prolonged shutdown? It's almost like the marketplace is starting to get used to it at this point in time, which is just a horrible thing to say. But it is. I mean, it's a real thing. So you're at 185 on Boeing. We could obviously just close it out. I think the path of least resistance is to the downside. So this is a good thing in that the trade is up. You almost doubled, right? We put it on for $1 and it could be 162. Now it's moved a little bit. That's the issue, is that you're right in the middle. We didn't get to the 240 level. If we went down to the 240 or just below, then it's a little bit easier to stay the course. But with a blink of an eye, if we bounce back to 245, this profit is gone and it's gone away. We only have a few days for the trade to live. It's 241.77. And it's a tough call if we should get out right now. Normally, this is what I would do. You'd get out right around now. You place an earnings trade after the announcement. You come in and just close out the position if the trade is kind of medium in your situation. So I think I just answered my question. I think we close it. I think you get out at what you can. I do think the path of least resistance is to the downside, but this is just too short of a trade. So in this instance, I just want to close it and get out and capture the gain. All right, enough said on that, except for we also did a long put spread. Now the long put spread was going out a little bit further in time. We added a week to it. We got higher reward. We were risking 375 for the potential to make 875 on that spread. And if I was in the long spread, I would stay. I would stay around only because we went out to February 9th and we got 9 more days for the trade to play out. So I still, once again, if something does happen over the weekend, I kind of look at, here's the way the marketplace is thinking about the government shutdown, is that it, we're obviously studying. We hit 7,000 in the SPX today, so we are still trudging higher as far as the markets are concerned. Right now, the VIX trading right around 16 doesn't show real angst in the marketplace as we set the new all-time high in the S&P 500 index. And so, if it doesn't happen, I guess you could see a boon for the market. I don't really, in other words, the market is acting like it's not going to happen right now, even though the probability market is showing the prediction market, I guess, not probability, prediction markets would be a better way to say it, is showing there's a high probability. The marketplace doesn't seem scared at all about it. So if it doesn't happen, I don't think it really does anything to the market. If it happens, I think the market's going to go down. I think it has to, right? But I was wrong about that the last time around. But right now, the VIX is at 1684. So it's up a little bit high today, considering the market's up. Yeah, so we got a little bit, we're showing a little bit more angst. We're up 0.49 on the VIX, trading at 1684. So they're showing a little bit higher probability. Gold setting an all-time high. There's a little bit of angst in the marketplace. Russell is down. NASDAQ, Dow, and S&P are all up fractionally at this point in time. But the S&P 500 index did hit 7,000. So I hope you had your hat ready. I should have made a hat, right, for the SPX 7,000, but I didn't get there. My bad. UNH, another story. All right, I'm not happy about this, and neither is Warren Buffett. Warren Buffett last year bought 5 million shares of UNH, $1.6 billion worth. It's not worth $1.6 billion anymore. The headline came out that the administration is not going to, basically, we'll just say it this way, not going to increase potential payouts for Medicare and Medicaid. Analysts were expecting a 5 or 6% increase. They came in basically at flat, and UNH really took it to the chin. They announced earnings. The earnings were trepid, and they had a small beat, and then they had fairly poor guidance. And with that thrown in with the major news about Medicare and Medicaid, we see the stock went down 20%. It's already started to make the bounce back. So yesterday, I actually did a podcast on this too, on UNH. I like to, this is one of my favorite sayings. I don't want the cheese anymore. Just let me out of the trap. On my position in UNH. And I want to introduce you to that trade. Now, the bounce back has already begun a little bit, but I was looking at the 300, 315. So I went out 30 days. It was 31 days yesterday. Now it's 30 days today. And if you have 100 shares of UNH or more, which I have more in my account, and I placed this trade yesterday going into the close, and here's the trade. You got to have 100 shares to do it. And as a matter of fact, I think it might be, let's pull out a little bit here. Let's go full screen on me. And I'm going to actually show you, because I think that it does justice to show you options playbook. Okay, so let's go pull this down. Let's pull up options playbook. And what the strategy that I'm going to highlight inside the options playbook is the front spread. And the front spread is commonly referred to as a ratio spread. But a better known strategy is the back spread, which is more looking for volatility than not. So why am I struggling? There we go. Now let's pull this over here and voila. Let's go back to the playbook. Okay. So here's a front spread with calls. And I've talked about this from time to time. This is one play that I think you should have in your playbook, in your tools, and not do it as often. You need some volatility to be created in order to do a trade like this. It's an alternative to a covered call. Some people call it a covered call on steroids. But the actual option strategy is just a front spread, but you tie it to the stock and it becomes interesting. So here's what the trade is. You buy a call option at strike A, usually a little bit out of the money. The stock would be trading somewhere down here. And then you sell two at strike B. Now, the two that you sell need to pay for the one at strike A. Hence the reason you need volatility. You need to see, in particular, even to have some volatility skew helps a little bit, especially if you're doing it on the downside. But if you buy this option, sell these two, so you're selling two out of the money options to pay for an at the money or just out of the money option. So you sell two cheap ones to buy one expensive one. Now, if you do this, you have unlimited risk, right? Because you are short one more option than you are long. You buy a call at strike A, sell two at strike B. Generally, stock will be below or at strike A, so down in this range. And so if you do this, you have unlimited risk. So a lot of people don't do it. You are naked a call option. Guess what? If you own the stock, you no longer have that risk. This entire graph that was like this goes like this, and it looks like a covered call. But you have much more upside than you do on a standard covered call. So front spread with calls, if you just type in front spread here inside the Playbook website, you can get there very easily. All right, so now let's bounce out. I don't need to move that much. There you go. And now we're back in. Now let's set it up. 30 days was a good period. I don't know how much vol has dropped. We're at 32% vol. The IV on the short term was 48. We're at 30. So we're actually giving back a lot of that volatility already. So that might not be as exciting as it was yesterday. But here's what the trade that I looked at doing. Buying this one, 315, 670. We're going to probably have to do the 305. All right. And it's close to even. Okay. So I got this trade done yesterday for a net credit of $1 because vols were way up. But here's the way we're going to have to set it up today. 10, 320. Okay. Yeah, it's not, we might have to even go out a little further. Let's see where this one is at. Net debit of 23 cents at the mid. I really want that to be a credit. All right, let's look at the 37. 305 buy, 320 sell. Ah, all right. That's a big difference in just going out an extra 7 days. But it works. All right. I did the trade with the February 27th yesterday. The market was down more. And I did the 300, 315 for a net credit of $1. Now, if I go out to the 37s, yeah, I don't mind this trade. So if you own 100 shares of UNH, just like myself or more, and Warren Buffett, Berkshire Hathaway, this is an alternative trade to say, I don't want the cheese anymore. Just let me out of the trap. It's not perfect. The stock was trading at about 350 before all of this, before the egg fell off the wall. And now if you do this, you're obligating yourself to sell your stock at 320, which I don't mind doing. It's in the retirement account that I have. I don't mind it, but I could try to avoid it if it gets back to 320 here. So here's a scenario. Let's send this to the what if calculator. And if you act quickly, like you have a situation where the stock fundamentally, the story hasn't changed much. I mean, their earnings report wasn't awesome. You still got a lot, there's a lot of insider trading that's going on by the bigwigs buying of UNH. But now this has changed the whole scenario, and who knows exactly what's going to happen, especially with the budget talks and everything that's going on with Medicare and Medicaid, and you got a midterm election that's coming up too. So all of that is going to weigh in. So the reaction today is obviously saying that, well, something is going to change in the Medicare and Medicaid payments. So you do this now. We're going to go back here, add equity, add 100 shares. Okay. So if we look at the trade, I'm just going to simply uncheck. And this is what I showed you. This is the way the profit and loss graph looked. One second. In the options playbook. This is the front spread. You have no stock. It's still an interesting trade, but you first of all have to be able to sell naked options, and the risk is not that fun. You have unlimited risk if the market goes beyond 336. Then you are net naked in UNH. It's not UNH isn't, well, I mean, to the downside, it's moved. So maybe it could move as quickly to the upside. But now once you add the stock, so for every 1/2 front spread or ratio spread that you put on, if you have 100 shares of stock to add to that, all of a sudden that's your profit and loss graph. Okay, so you notice that the rise over run from here to here is 2-to-1. So it's like owning UNH on margin from 305. Unfortunately, yesterday I did it at 300. So 305 to 320. For every dollar that UNH goes up and that you make on the stock, you will make an extra dollar on your long option. So if it goes up 15 points from 305 to 320, you make 30. A little bit better than just doing a covered call and bringing in, let's say you sell the 320, you're going to bring in $4, right? You can make $15 in this scenario, or you can make $4 in that scenario, above and beyond any profits on the stock, of course. If the market goes down, if you get this done for a net credit of $1, yeah, it really moved quick. I was kind of surprised by that dollar, but if you've got it done for that net credit of $1, anywhere on the downside, you just keep that dollar. You're not stuck in the stock. If the stock goes down, you can still close the position, the ratio spread, and you actually just got to close the short option. You can close the short option and still sell the stock, just like you would if you were in a covered call position. So this is a tool that's in a toolbox when you get blindsided by news, vols jack up, and you have this opportunity to do this trade. So it gets you back to 320. Add another 15 onto the stock, you're really selling it at 335. But to start this whole thing, if we look at the chart, it was recently at 350 when we did the trade. Let's go UNH. Yeah, so it was as high as 354. We were trying to fill the gap again. Man, that's just a sad thing. We were on the way back to 380, and boom, all of a sudden we're down here at 280. So it gets us back to right about here, and I would take that. So if I get assigned on mine, which you can still adjust it. Mine was 315, so I'd be selling right at about 330. I ended up buying all the way back here. Yeah, I might be just fine because I gotta go back and look exactly when I bought the underlying, but it was somewhere in this range after this dip. Came all the way down to 228. All right. Any questions about that trade? It's a very interesting trade. I remember it from when I was at the Options Institute of the Chicago Board Option Exchange. You would talk about it a lot. It's hard to find in scenarios where there's just normal markets. You can't get enough premium on the out of the money options to pay for the one that you're trying to buy. But a very interesting alternative to just selling the call and trying to capture the premium that way. And in this scenario, it really does work. And you got to have fairly expensive stock, fairly volatile news event that happens, and the quicker you act to capture that implied volatility, the better it is. The bounce back today, grabbing it, going up 8 or 3%, just really collapsed the vol. That was probably the more interesting scenario. But I can 100% let you know that I did do this on my stock, and I'll take the risk of it getting called away at 330 over the next 30 days. My expiration is February 27th. All right. UNH, we looked at. Let's go to VIX. Now, remember, this is the derived value, and it's a little less than where the actual VIX is at right now. We're showing the VIX today. Don't forget, that could also be adding to the VIX too. Is the Fed speaking today? The announcement is at 2. The conference call is at 2:30 Eastern time, and that could be adding a little bit to the volatility also. Highly anticipated that nothing's going to happen. It's more so they'll be looking at how many people, will everybody agree that interest rates should stay where they're at, or there'll be people that will dissent on their vote. And that will be a big part of that meeting and outlook today, is how many dissenters that the board has. So right now, VIX is at 1681. Here's the way I would play this. I would wait until the Fed meeting comes out, look to see if we get a little bit of a drop in the VIX index. I'm not as worried about the Fed meeting today as I am about the potential government shutdown. If we go out to the February expiration, that's 21 days away, and we look at where is the actual VIX index, and we'll just do this by using the put call parity, 175. So it's probably 1875 is about where I would guess it's at. So let's buy this one. Let's sell this one. Yeah, 1875 almost exactly. You take 1875 and you add that debit, and that's where the market's at. So we're looking at 1875 is where the February future contract is trading. Well, I wonder where the March future's at. I bet you it's higher. I'm guessing the March future is going to be around 20. 49 days away, 21 days. Okay, let's go look at this one. And I'm just going to buy a call after the VIX comes down a little bit, after the FOMC meeting today. I'm going to look to buy a long call in the VIX. Okay, so do I want it? The question now becomes, do I want the February expiration or do I want the March expiration? And in the March, we are 19 and a half. So we're probably about 19 and a half. The ask on the call is 259. The ask on the put is 249. So it's going to be a little less than 9. We'll use the 19 because then we can just add it. We're going to buy this one. We're going to sell this one. Put call parity. So it's a little bit more. Okay, so 19 plus 85 cents. So it's 1985. 1985 is where the futures contract for the March expiration is at. It's below 20. Paying a lot more juice for it though. And where is the VVIX at? I'm going to go pull it up over here on my other screen. So the VIX of the VIX, which is 30 days out, which is right in the middle of these two expirations. Remember, we never want to use weeklies. They're just too illiquid. We only want to use the monthly. So we're looking for the symbol that says VIX. The volatility index of the VIX is 104, which isn't outrageous. I would say 95 is normal. It's a little bit elevated. As high, the VVIX has traded as high as 129, 130, but about 130 is the high in the VVIX over the last 6 months. And right now we're at 104. The bottom end is 90. The bottom end is 90. Paying a little bit of vol premium. That might come down a little bit after this earnings report. 21 days. The last government shutdown was 41 days. Let's do the March. We're going to have to pay up for it. We're going to be paying some premium, but let's look at the March. And let's buy the 20s. Just out of the money. No, let's go a little bit in. 18, that means it's got to get to 21. It's got to get to 22. Let's do the 18. Here's going to be the official paper trade. We're just going to buy the 18 strike March expiration. Pay $3 for it. $300 is our risk. If the government shutdown doesn't occur, I don't expect a huge movement in the March 18th expiration. So if we get to midweek next, in other words, I don't think there's a ton of risk reward in this trade, in that if we get to March 18th and, well, I'm sorry, if we get to midpoint next week and it looks like there's not going to be a shutdown, I don't expect this to move that much. 19.5 is about where the market was at anyways. Going out further in time, even going out all the way out to June, you're still sitting at about a 20% volatility. I'm guessing. And so in this instance, I don't think this moves that much, but I do think that if we do get a government shutdown and it prolongs, goes day 10, day 11, that we could see something happen that could create a huge spike up in the VIX index and a dropping of the S&P 500 index. We're a little frothy anyways in the SPX. Just hit that 7,000 level. Always hard to break through it. Timing is right to buy a long VIX option. That's simple. Any questions on the VIX? Remember, I have an article called Decoding the VIX. If you go to my profile and you look at my articles, it's a tab across the top. You're not just the normal chain. There's a thing that says articles. You can find the article Decoding the VIX, and it talks a lot about if you want to trade VIX options. But this is a time, I think, to take a shot in the VIX. If you put it on for 3 and it's trading for 2, you can just get out. A lot of people that trade VIX want to lean into a long call spread because you can see the type of premium you can get way out of the money, right? So you buy this 18, you can go all the way up to the 32 strike and you can still get $1. So instead of paying, that's a third of the price. Now, the downside is if you sell it and the market does make that huge move up, man, it really hurts you. It really hurts you on the 32 strike to sell some of that premium. because you in the VIX, it almost like the UNH trade. When the UNH trade, when it happened yesterday, that was the day to do the front spread. That was the best day to see is, are we going to try to catch a falling knife here? If it continues to fall, we still get a buck. We still make a buck off of our front spread, getting it done for a net credit of $1. But if it doesn't, right, and it makes that dead cat bounce, well, now you can double up to catch up pretty quickly. We couldn't quite double up to catch up because the movement was too big in UNH. 20% was a huge, to me, that's way overdone. Something's going to happen in the Medicare space. I don't think that, something's got to happen. So with the VIX index, if you get that huge spike up, I don't want to battle this 32 strike. You're battling it, and that makes you wait. You're like, well, I would get out of this trade, but the 32 strike has too much vol premium in it. I don't want to get out. So the VIX is the one underlying that a lot of people don't buy options outright because you pay so much premium. Paying $3 for an $18 stock, for example, would mean implied volatility is just through the roof. So it's the one index that I think buying options outright on the call side makes sense. Now, you want to get really nutty. I think you go to February. I'm just kind of curious on this. Yeah, you can't get a lot. Now, these don't tie in together because they got different futures that are trading, but the market's at 18.5. You sell the 18 and buy the 16, bring in a buck. And this one I would do now. Well, maybe you wait. Maybe you wait on that one too. So the 18 you sell. The 23-cent one you buy, and you bring in $1 that way. That's not bad. 3 points wide. You're getting a third of the spread. You're selling the 18, buying the 6. Oh, it's 2 points wide, and you're getting a buck for a 2-point wide spread. The market's at about 18.75 right now. You're selling the 18, buying the 16. It's not too shabby. That's not a bad way to play it too. That's 21 days out. Or you could do them both. You could sell this put spread and help pay for your long call on the March 18th expiration. Like I said, it was going to be a long show today. I apologize. I'm getting long-winded. That's it for this edition of Options Guy TV. I do too many podcasts nowadays, but Options Guy TV. And we'll be back. This Friday is going to be a real interesting day in the markets. I don't think I want to leave early on Friday to just to see the feeling heading into the weekend. And there got a lot of things happening the weekend. The winter storm is still going on. We're in Charlotte, North Carolina. We're not going to get above freezing all weekend long. That's going to create issues. There will be pipes popping and bursting all throughout Charlotte over the weekend, because you won't get the afternoon thaw like you usually do. And there's just going to be a lot of stuff happening. This weekend's going to be interesting. So with that said, we'll see you this Friday. Don't miss the next edition of Options Guy TV, 11 a.m. Eastern Time, inside the Tradier Hub on YouTube, in my X profile, anywhere that you can find it. You want to pay attention this Friday. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.